For decades, the 30-year fixed mortgage helped sell a simple version of the American dream. Buy the house, lock the rate, pay it down over time, build stability along the way. That idea became so familiar that many Americans started to treat a fixed mortgage like a fixed life. Forbes framed it well years ago. Home financing did not just help people buy homes. It helped shape what homeownership meant in the first place. That promise is still alive, at least on the surface. The US homeownership rate was 65.7% in the fourth quarter of 2025, and Freddie Mac says the average 30-year fixed mortgage rate was 6.11% as of March 12, 2026. But the old equation is getting harder to trust. A fixed mortgage can still lock the loan, and it cannot lock the cost of keeping the house. So this is not just a story about getting approved for a mortgage. It is a story about what happens after the papers are signed, when the loan stays fixed but the life around it does not. On paper, the financing system still looks familiar. There is still a standard mortgage. There is still a monthly payment. There is still a belief that homeownership becomes more stable once the rate is locked. But that is only part of the bill. The Atlanta Fed's Homeownership Affordability Monitor uses a simple rule. If the full annual cost of owning a median-priced home rises above 30% of median household income, homeownership is unaffordable. And the key phrase there is full cost, not just principal and interest, also property taxes and insurance. That matters because it changes the whole question. The issue is no longer only whether a family can qualify for a mortgage. It is whether they can keep carrying the house once they have it. In real life, odds that pressure usually does not show up in one dramatic moment. It shows up in a higher escrow payment, a bigger insurance renewal, a tax notice, a repair estimate. The mortgage statement may still look steady. The total cost of staying put often does not.
Consider a household like Melissa and Andre. This is a composite example, but the math is real. Melissa is 42 and works in medical billing. Andre is 45 and manages fleet maintenance for a local contractor. They live outside Orlando with their teenage daughter. Together, they make about $98,000 a year before taxes. They bought their house in 2021, when rates were lower and buying still felt like the smarter long-term move. Their mortgage principal and interest comes to about $1,840 a month. That payment has barely changed. From the outside, that makes them look secure. But the rest of the house has its own budget. Property taxes, $310 a month. Home insurance, $430. Utilities and internet, $360. Maintenance reserve, $275. HOA, $110. That brings the monthly cost of keeping the house to roughly $3,325. So now add 2 car payments, auto insurance, groceries, gas, healthcare, school costs, and phones. After taxes, they bring home about $6,600 a month. By the time the house and the rest of basic life are covered, they have around $300 left. That is not stability. That is a narrow margin. Nothing has to collapse for the pressure to feel real. One repair, one higher premium, one missed paycheck, and the month changes shape. This is where the old housing logic starts to break down. A fixed mortgage fixes the financing cost of one part of homeownership. It does not fix the rest. Treasury's financial stability. Oversight Council said in its 2025 annual report that property taxes and homeowners insurance payments have increased significantly over the last 5 years. It cited ICE data showing property tax payments up 22% over 5 years and average homeowners insurance payments up 61% over the same period. Treasury also said that this raises all-in mortgage payments even for borrowers who already have lower fixed-rate loans. Insurance is one reason. Treasury's Federal Insurance Office said in January 2025 that homeowners insurance is becoming more costly and harder to obtain for millions of Americans as climate-related losses reshape the market. On taxes are another reason. Local governments still need revenue, and rising assessments often push that burden back onto homeowners. Repairs are a third. A house ages whether rates are low or not. Roofs wear out. Systems fail. materials, and labor cost more than they used to. Then there is the lock-in effect. Treasury noted in 2024 that higher interest rates have made it harder to become a homeowner, partly because current owners are more reluctant to sell homes with low-interest mortgages. So even when a house becomes harder to afford, moving may not feel like a real solution. That is when the problem stops being only financial and starts becoming psychological. When the cost of keeping a home keeps moving, people lose planning range. They stop asking, "How do we get ahead this year?" and start asking, "Can we make it through the next renewal, the next tax bill, the next repair?" The pressure is not just that housing is expensive, it is that the cost feels less predictable than it used to. That changes behavior inside the home. Maintenance gets delayed, savings slow down, vacations disappear. A child's activity fee becomes a real decision. A job change in another city gets harder to consider because the mortgage in hand feels too valuable to give up. Over time, the house stops feeling like a base and starts feeling like a system that has to be managed all the time. And that may be the deeper cost here. Homeownership was supposed to reduce uncertainty for ordinary families. In more and more cases, it is simply changing the form that uncertainty takes. Not every homeowner is in trouble. Many still have equity. Many still have lower payments than they would if they tried to buy the same house today. That is exactly why this shift is easy to miss. From the street, the house still looks like stability. The mortgage gets paid, the lights stay on, the family stays put. But underneath that surface, the terms have changed. The real question now is not just whether Americans can still get mortgages. It is whether homeownership still delivers what people thought they were buying when they signed the papers. Not just shelter, not just an asset, but predictability. Because if the loan is fixed while the cost of keeping the life around it is not, then the promise of homeownership has changed in a very quiet way. And quiet changes are often the ones that last the longest.